Hello, and welcome to the Investing on the Go podcast. I'm Chris Sarley, and today we're joined by Dale Nicholls, manager of the elite-rated Fidelity China Special Situations Trust. Thanks for joining us today.
Thanks, Chris. Good to be here.
Going to start with a bit of geopolitics. So I guess, what does a Biden presidency mean for China and its companies, and does it change anything or the direction of travel for the country?
Yeah, it was obviously still very early days, but every indication we get that it's going to be very much the same. As we've seen in the the appointment hearings with Yellen, et cetera, it seems like the line is very much the same, and it's going to be a relatively hard line. I think the changes you can expect, at least from the US side, is probably a more multilateral approach, and I think probably see an increased focus on human rights, probably at the margin. I think, from the China perspective, one thing they'll probably appreciate is just a little bit more predictability. And I think probably investors are in the same category there, in terms of US policy. But overall, I don't expect a huge change, in policy there. I think, the competition and friction there is really going to be with us for decades going forward. I think, from a market perspective, on the positive side, I think that's more accepted, and probably pretty much consensus.
Okay. China was part of a huge interregional trade deal that was signed last year. Could you explain what the deal is, and does it open up any opportunities now or in the future?
Yeah, it's obviously pretty significant. When you think about the countries that are included, we're talking, probably around 30% of global GDP and population, and it's about bringing down a lot of the tariffs and sort of trade barriers that are there. So that's it's obviously pretty significant. For me as an investor, investing in China, it's probably less significant than I would say probably if you're investing directly in some of the countries in Southeast Asia that sort of will have probably less fettered access to a lot of the markets. But it's clearly a huge positive just in terms of reducing trade friction, trade barriers. So I think over the long term, you've got to definitely view it as a positive. But as I said, for me, I'm focused more on the domestic opportunity in China. When I look across the sort of investment universe that I'm focused on, you could pick out maybe some shipping companies. There are some textile companies that have capacity in Southeast Asia that will clearly benefit, particularly the ones that I think are selling into places like Japan. But again, for me, I'm really largely focused on the domestic opportunity in China. The tech companies, the growth of the middle class, the consumer in general, areas like healthcare and that sort of thing. So, a positive, but sort of no direct links to a lot of the companies I have in the portfolio.
And obviously, there's only been one story that sort of dominated in 2020. Could you maybe give us a bit more of an insight on how China's fared since the onset of the pandemic in the past year or so? And has the economy opened up? Are there more problems sort of coming around down the road again now for the region? Yeah.
So, I think, China overall has done a really good job of getting things under control. Obviously, it was a pretty strict approach, strict measures in terms of lockdowns initially, but that allowed them to get the numbers down significantly, and on the back of that recover pretty quickly. I'd say that the recovery probably started more on the industrial side, a lot of the manufacturing companies. The ones that we're speaking to, they're sort of back to full production, in the first half. For the more consumer-related areas, the recovery has been slower, but sort of generally improving month by month. And I think towards the end of last year, a lot of huge parts of China are just back to normal, particularly in the south. Obviously, of late we've seen some flare-ups in terms of numbers, and I think that's had some impact. When we look at some of the numbers that we saw in December, we saw a bit of a slowdown. So, retail sales sort of dropping below 5%, which is the number we saw in November. And in discussions we have with, for example, some of the restaurant companies, some of the hotels, we've seen a bit of a drop off. I think there's probably a weather factor there as well. We've had some sort of, pretty bad weather, particularly in the north. So it's probably a factor as well. But I think COVID is having some impact. Having said that, I mean, the government reacts quickly. and I think you got to be pretty confident that they can definitely keep things under control.
Sorry, I was going to say, I wanted to touch a bit more on the specifics of the portfolio.
Sure.
I noticed you've got 30% invested in US listed companies. Can you explain why this is, please, and sort of the types of companies that those holdings are in?
Sure. Well, I'm investing in China, and so where the companies are listed is less of a factor for me. It's really where their businesses are, and the fact is that a lot of the tech companies are listed in the US. So the likes of Alibaba, 21 VNet, in the tech space, but some non-tech names like Noah, which is a leader in wealth management, is also listed in the US. Obviously, some of these companies are now listing in Hong Kong as well, but the fact is, a lot of particularly the tech companies are listed in the US.
You mentioned tech. There's about 15% of the trust invested in that sector. Could you maybe explain what other opportunities you're finding in other sectors as well? Because it's maybe not as high as perhaps some people would think, and obviously it's not impacting performance. Maybe just give us a bit of a snapshot of what you're seeing.
Yeah, that's actually a bit misleading in terms of sector naming in MSCI China right now, because you're missing big swaths of companies which are in many ways tech companies. So most of the e-commerce companies come under consumer discretionary. And then you put Alibaba in that category, and then you've got Tencent, which is in communication services. So those two names alone, you've got to sort of add 25% to the tech component. So it is actually pretty significant. In terms of sort of overall tech exposure. Outside of tech, the areas that I think really have the great long-term growth prospects in China, really anything consumer related, and that's why you'll see consumer discretionary is a really big category for me. Just really benefiting from the natural growth of the middle class in China, and the other area is healthcare, which will continue to grow in China. There's a lot of government support, but there's just a huge amount of development activity in China now. So focused on the companies that are really doing, particularly the innovative work in that space in China. It's a pretty exciting growth area for the long term.
And sort of as we sit here, maybe just give us your outlook for China this year, for 2021, and what excites you most, and maybe talk us through some of the threats you're also wary of in the region.
Sure. Well, I still think there's a lot of opportunity. It's a market. I think just looking at the economic backdrop, we're as you've seen, China was really the only large economy to grow last year. The outlook still looks pretty good for this year. I think sort of most people are forecasting sort of growth around the 8% level, and you can assume that consumption is sort of growing, faster within that category. So I think the backdrop looks good. As we've talked about with COVID, I think there's probably a lot more uncertainty in other markets relative to China. We know that they have a pretty good track record of keeping things under control. So I'd say the risks are relatively low as well. If we were going to talk about risks, I'd say, clearly the valuations are not as compelling as they were, when, that we saw sort of obviously at the beginning of last year with the market sell-off. And there's clearly some frothiness in parts of the market. So I think you need to be wary of that. Additionally, we've got, obviously signs of regulation in a number of sectors, particularly the tech sector. So we need to sort of watch how that plays out. There will be opportunities. Obviously, the focus is on the larger companies. So, we'll see how it plays out, but there could be opportunities for smaller companies as a result of that. But overall, I'd say, the overall backdrop, still looks pretty positive. It's just I think it's going to be a market where you're going to have to focus a lot more on stock picking as opposed to just relying on performance of the overall market.
Are you holding back a bit of cash for those opportunities you mentioned, or how are you sort of playing that?
Well, as you know, as a closed-end fund, we have gearing. I have sort of brought the gearing back slowly as things have moved up. It's been an opportunity to take some money off the longs, added to some of the short opportunities. So I'm finding that the net gearing sort of gradually coming down. for those regions.
That's great, Dale. Thank you very much for joining us today.
Great. Thanks a lot.
And if you'd like to learn more about the Fidelity China Special Situations Trust, please visit FundCalibre.com. And while you're there, remember to subscribe to the Investing on the Go podcast. Please remember, we've been discussing individual stocks to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these stocks at your time of listening.